Hello. One of the most important decisions businesses make is hiring new employees. With the hiring of employees comes the responsibility to adhere to labor laws and payroll regulations, the accurate calculation of wages and deductions, as well as the submission of payroll taxes to government agencies. In many small businesses, the accounting team is also responsible for payroll and the payroll tax returns. When I worked for small businesses as a controller, I managed the HR setup of new employees, benefit plans, weekly payroll, and payroll tax returns. It was a really helpful learning experience for me earlier in my career because I learned how all of the different pieces in the payroll register make the payroll journal entries and where to look when something did not match. As an accountant, it is important to understand labor laws and payroll laws. And in this video, we'll cover the FLSA, how minimum wage differs by state, the controversial topic of subminimum wage, as well as the calculation of employee earnings and payroll taxes. First, let's talk about one of the most important pieces of labor legislation. The Fair Labor Standards Act, or FLSA for short, protects non-exempt workers through its rulings on minimum wage and overtime. Before the FLSA was enacted in 1938, there wasn't a federal minimum wage, although 25 states had passed minimum wage laws. California, for instance, had a minimum wage of 16 cents in 1920, and by the time the FLSA passed in 1938, the minimum wage in California had more than doubled to 33 cents per hour. Before the FLSA, child labor was allowed and children as young as 5 worked in factories. The FLSA's protections are primarily for non-exempt workers, though. So what's a non-exempt employee? They're primarily hourly workers unless they work for companies that aren't subject to the provisions of the FLSA. For instance, companies who engage in no interstate commerce whatsoever, which is becoming rare because of e-commerce, and firms that have less than $500,000 in annual business volume. In those two cases, the FLSA provisions do not apply, meaning the employees get paid a lower minimum wage if the state's minimum wage is lower than the federal rate. On the other hand, certain businesses are always covered by the FLSA, such as hospitals, schools, and government agencies. The federal minimum wage is currently $7.25 per hour, and it hasn't changed since 2009. Many would argue that that is not a livable wage for employees. On the other hand, each state has the option to pass their own higher minimum wage. But before we talk about the minimum wage across the U.S., let's talk about California. California's minimum wage rate is $16 for all employers. However, some localities have set their own higher minimum wage rate. For example, in Los Angeles County, the minimum wage is $17.28 in the city of Los Angeles and $17.27 in unincorporated areas. Emeryville in Northern California has a minimum wage of $19.36. Certain categories of workers, such as hotel workers, have a higher minimum wage rate. For instance, in the city of Los Angeles, employees who work at hotels with 60 or more guest rooms have a minimum wage rate of $20.32. Salaried employees who hold supervisory or managerial positions are called exempt employees because they're not subject to the maximum hour and overtime premium pay provisions of the wage hour law. The minimum wage differs from state to state. As of July 1st, 2024, the minimum wage ranges from $7.25 to $17 per hour. As discussed, there could be higher minimum wages in certain localities or job categories within a state. Did you know that the hourly minimum wage for tipped employees is $2.13 per hour for the FLSA? But employers must pay the employee at least the full minimum wage if the tips do not make up the difference between the full minimum wage and the tip minimum wage. However, tipped employees are not the only workers who may legally receive compensation lower than the minimum wage. Young employees who are less than 20 years old can be paid $4.25 per hour up to 90 days. Disabled workers can be paid less than the federal minimum wage, sometimes only pennies, if an employer obtains a certificate. Another category are full-time students who are employed at retail stores, in agriculture, or at colleges and universities. These students can be paid 85% of the federal minimum wage. Starting in 2025, California will ban the practice of paying sub-minimum wages to individuals with intellectual or developmental disabilities. Unlike the federal requirements, the state of California also does not allow employers to pay sub-minimum wages to student workers or workers under 20 years old. And the tip minimum wage in California is $16 per hour. Now that you know about the minimum wage and one of the most important pieces of labor legislation, let's talk about payroll. The first step in preparing payroll is to compute the gross wages or salary for each employee. And there are several ways to compute earnings because employees can be paid in a variety of different ways: hourly, salary, commission, piece rate, and sometimes a combination of these methods. If employees are paid on an hourly basis, then workers earn a stated rate per hour and earn overtime at time and a half, meaning every overtime hour earns 50% more than the regular hour if they work more than 40 hours a week. In some states like California, time and a half overtime applies when employees work more than 8 hours a day. Double time applies if the employee works more than 12 hours in a single workday, or more than 8 hours on the 7th consecutive workday. The employee's gross pay depends on the number of hours and overtime hours worked. Salary basis employees can earn an agreed upon amount for each week, month, or other period. The Fair Labor Standards Act states that employees must be in certain administrative, professional, creative, or executive positions and earn at least $684 per week to be considered a salaried employee. As of 2024, the minimum annual salary to qualify for an exempt employee in California is $1,280 per week per employee to be considered salaried. Some salary employees are also overtime eligible, but typically there's no overtime pay for salaried employees. Commission basis employees, usually salespeople, earn a percentage of the net sales that they generate. There are different rules for inside and outside salespeople. Inside salespeople are employees where the customer comes to the place of business. For those employees, the FLSA applies and employees must earn a minimum wage. Outside salespeople are employees where the employee goes to the customer to make a sale. In the case of outside salespeople, the FLSA does not apply, and the total pay of an outside salesperson can be below the minimum wage. Piece rate basis employees are paid based on the number of units produced. That could be, for instance, a bakery employee who is paid based on the number of cakes decorated, or a social media employee who is paid based on the number of social media posts, or a part-time college professor who is paid a fixed rate per class that they teach. However, the employee must be paid at least the minimum wage under state law or federal law. Here's an example of calculating gross wages when the employee works regular and overtime hours. Let's read it together. For 1 week, 3 employees of the Snowshoe Lodge worked in the number of hours shown below. All of these employees receive overtime pay at 1.5 times their regular hourly rate for any hours worked beyond 40 hours a week. Compute the regular earnings, overtime earnings, and gross pay for each employee. So let's look at employee number 1. This employee worked 47 hours at $13 per hour, and overtime needs to be calculated for all hours above 40. And our calculation in this case is 40 hours times 13 equals 520, plus 7 hours at $19.50 equals $136.50, all combined $656.50. For employee number 2, we calculate 40 hours at $9.50, which equals $380, plus 6 hours at $14.25 equals $85.50, total $465.50. Employee number 3 has 40 hours at $9 an hour, which is $360, plus 4 hours at $13.50, which is $54, and combined, that's $414. After calculating the gross wages, we also need to calculate payroll tax withholdings such as federal income taxes. Employers are required to withhold from employees' earnings an estimated amount of income tax that will be payable by the employee on the earnings. The amount depends on the Form W-4, and there have been a few changes on the Form W-4 in recent years that are not yet reflected in our textbook. There are several different ways to compute the federal income tax to withhold from an employee's earnings, but the wage bracket table method is almost universally used. The wage bracket tables are in Publication 15T, Circular E, and here's an example of the weekly payroll period wage bracket table. And next to it is an example of a biweekly payroll period wage bracket table. The manual calculation of federal income taxes can be quite complex if it involves pre-tax deductions and dependent exemptions. If you're interested in learning more about labor laws, payroll regulations, calculating gross pay, as well as fringe benefits, payroll taxes, and payroll deductions, I recommend you check out the payroll accounting class. In addition to federal taxes, employees also have Social Security and Medicare tax withheld from their gross wages. Social Security and Medicare taxes are paid by both the employee and the employer. Let's talk first about Social Security. The Federal Insurance Contribution Act, FICA, is commonly referred to as the Social Security Act and provides retirement benefits for workers and dependents of retired workers and disability benefits. The Social Security tax rate is 6.2% and has been unchanged for many years. There is a maximum wage limit, though, for Social Security taxes. For 2021, the wage base limit is $142,800. In 2022, the wage base limit is $147,000. In 2023, it's $160,200. And in 2024, it's $168,600. Our textbook uses the 2021 rate. The wage limit means that Social Security taxes are calculated up to the wage limit, but there is one exception. If the employer works for multiple employers during the year, all employers are required to withhold Social Security. However, the excess above the maximum is refunded on the employee's income tax return. Now let's talk about Medicare tax. Medicare tax is closely related to the Social Security tax. Just like Social Security tax, the Medicare tax is a tax paid equally by employees and employers to provide medical care for the employee and the employee's spouse after each has reached 65. The Medicare tax rate is 1.45%. And the Medicare tax applies to all salaries and wages paid during the year. That means that there is no wage limit like there is for Social Security tax. The Affordable Care Act created an additional Medicare tax of 0.9% on single taxpayers with earnings of greater than $200,000. That means single high-income earners will pay 1.45% in Medicare taxes on all earnings and an additional 0.9% of Medicare taxes on earnings greater than $200,000. For married taxpayers, the limit is $250,000. And for taxpayers with the filing status married filing separately, the limit is $125,000. Employers are not subject to this additional Medicare tax. Here's an example to illustrate the calculation of Social Security taxes. What we have here are the monthly salaries for December and the year-to-date earnings of the 4 employees of Lincoln Project Company as of November 30th. Employees 1, 2, and 3 are far below the maximum Social Security wage limit of $142,800 when we add the December wages to the year-to-date November wages. That is why we have to only multiply the December wages by 6.2% to calculate the Social Security tax. For instance, employee number 1 has $9,000 in December wages and his total wages are below $142,800. So we multiply $9,000 times 6.2% to arrive at $558. We then do the same for employee number 2 and 3. Employee 4, however, has November year-to-date wages of $132,000, and when we add the December wages to the November wage, we get $146,000. This is above the maximum wage limit for Social Security, and that tells us not the entire December wages are subject to Social Security taxes. We calculate the difference between $142,800 and the November year-to-date wages of $132,000, which is $10,800, which we then multiply by 6.2% to get $669.60. We're going to use the same example for the calculation of the Medicare taxes. Medicare tax does not have a maximum wage limit, and all we have to do here is multiply the wages times 1.45%. In this case, we don't have to worry about the additional Medicare taxes of 0.9% for high wage earners. There are many other withholdings and deductions, such as state and local taxes. For instance, in California, we have the state income taxes, and we also have the state disability tax. In New York, there's a New York state tax and a New York City tax. Some states don't have any state taxes at all. In addition to taxes, other deductions are withheld from an employee's wages. Some are mandatory, such as garnishments, whereas others are voluntary, such as 401k, health insurance, and pre-tax deductions, such as childcare. There are also post-tax deductions, which means there isn't a special tax advantage, such as donations, union dues, and gym membership. The employer is responsible for withholding and remitting federal, state, Social Security, and Medicare taxes, and other deductions such as 401k, health insurance, and other deductions. Non-compliance can result in significant penalties. In addition, the employer is responsible for the employer's share of Social Security and Medicare taxes, state and federal unemployment insurance, and workers' compensation insurance. Often, the employer also matches the employee's 401k deduction and pays a significant portion of the employee's health insurance and disability insurance. All the payroll information for the payroll period is captured in the payroll register. Here's an example. It starts with the name of the employee and the marital status. Typically, you would also see the number of dependents listed here and any additional withholdings the employee is requesting. Next are the number of hours and the hourly rate, and the calculation of the regular and overtime wages. The payroll register then continues with the taxable wages for Social Security and Medicare taxes. And typically, there would also be a column for federal and state taxable wages. In our example here, all of the taxable wages are the same. However, when employees have pre-tax deductions, the amounts subject to federal Social Security tax and Medicare tax would be different from the gross wages. The next set of columns are the deductions for Social Security and Medicare and income taxes, as well as health insurance. Finally, we get to the net pay, the check number, and the distribution of the wages by type. In this case, office salaries and shipping wages. Now that we've learned the basics about gross wages, taxes, and deductions, we can continue in the next video with how accountants record this information in the general journal and post it to the general ledger.